The next financial crisis won't arrive as a surprise. It will arrive right on schedule. We just won't admit it until after the damage is done. Every time the economy shakes, we're told the same story. This came out of nowhere. It was unpredictable, a once-in-a-generation event. That story is comforting. It lets everyone pretend no one saw it coming. But the truth is quieter, colder, and far more uncomfortable. Because financial crises follow patterns, and the people who designed the system know those patterns very well. Right now matters because we're living in the aftermath of the last emergency. Trillions created, interest rates whiplashed from zero to restrictive, assets inflated, then cracked. And once again, central banks stepped in as saviors. So let's slow this down. What actually happens before a crisis? First, growth starts to stall. Debt quietly builds. Governments borrow more. Companies borrow more. Households borrow more. Because borrowing feels painless when money is cheap. Central banks help. They lower rates. They inject liquidity. They promise stability. This works at first. Asset prices rise. Stocks climb. Real estate booms. Risk looks smart. Then leverage piles up. Returns depend less on productivity and more on cheap money continuing forever. That's the fragile point. It's visible, it's measurable, and it's usually ignored. When something finally breaks, housing, banks, bonds, the response is immediate. Emergency meetings, new facilities, massive interventions. This is the part we call saving the economy. But here's the uncomfortable math. When central banks step in, they don't rescue everyone equally. They stabilize markets by supporting asset prices. Assets are mostly owned by the top slice of society: stocks, bonds, property, businesses. So while wages lag and prices rise, portfolios recover fast. Sometimes they even grow larger than before. Losses are socialized. Gains remain private. It's not a conspiracy, it's an incentive structure. Central banks are tasked with preventing collapse, not fixing inequality. And the fastest way to stop collapse is to protect the financial core, even if that quietly transfers risk downward. Publicly, the hype sounds heroic: decisive action, market confidence restored, crisis averted. Underneath, the system becomes more concentrated, more indebted, more dependent on intervention, which sets up the next crisis. That's why these events feel predictable, not because timing is exact, but because behavior is consistent. Cheap money encourages risk. Risk accumulates quietly. Intervention rewards scale, and the cycle repeats. The real question isn't whether another crisis will come, it's this: when it does, will we finally admit who the system is designed to save, or will we call it